good morning, ladies and gentlemen. My name is Patrick O'Sullivan. I'm a professor here at Grenoble École de Management, and it is my great pleasure to be moderator for this session of the Geopolitics Conference on the topic of Africa debt rising. I'm very pleased to introduce our august speaker, Paul Adams. Paul has an extensive experience in Africa. He was, in fact, the Financial Times correspondent for Nigeria through some of the most turbulent years of the Nigerian transition in the Babangida regime and in the aftermath of the failed election at that time. Following that, he was in Abidjan as correspondent, once again, for the Financial Times and Reuters, and for in-field ECOWAS coverage of the region, specifically related to economic and financial news. Paul was also the African Financial and Economic Risk desk head, for Kroll Associates, a risk analysis consultancy, advising and consulting to both investing corporations and governments. And his work now is at the Africa Research Institute, which he tells me is a small but influential think tank situated in London. Paul's going to talk to us about the question of debt, an extremely interesting and important topic. We think of debt in Greece and so on, but today I think we're going to hear something about debt in Africa. Without more ado, I will hand over to you, Paul.
Thank you, Patrick. Good morning, everybody. It's a pleasure to be here. I'm going to do something that I don't normally do, which is talking to the public at large. Generally, in my work, as Patrick explained, I do consultancy, and this takes various forms, but I specialize in essentially in business and the economy in sub-Saharan Africa. Just to preface my remarks, when I'm talking about Africa, I don't cover the Arab-speaking north, so I'm talking about sub-Saharan Africa. Now, I've got some slides here which are drawn from my research, which should illustrate some of my remarks, but I also want to make some general comments around the subject. And I see from looking around that the majority, I'm guessing, of you are students, and you may be aware of the current predicament of some of the economies of Africa. This is largely connected to the slowdown in global demand for Africa's commodity exports. And this has produced some shocks in developing economies in Africa. And the theme I want to explore in this talk is about the movement of capital. Global capital finds new frontiers. But the question in these situations is, do the new investors in these frontier markets understand the countries in which they wish to invest? And do the countries, the governments in the countries they want to enter, do they understand how these investors operate? My impression is often the answer is no. Now, there's plenty of data about the economy of sub-Saharan Africa. But understanding an environment takes time and patience. Some of the new investors may lack that. If things go wrong, it is the African public who ultimately suffer, which is why I think this is an important subject. Now, we have had wildly altering perceptions of Africa's prospects. You may remember that 10 years ago, there was a slogan, Africa Rising. You don't hear that very often now, and indeed, harsh economic times are returning. How can our perceptions be balanced between the slogans which appear to be in fashion at the time and the underlying facts? Let's just go back to the 1980s, when Africa's indebted and commodity export dependent economies went into crisis and were forced to go through a painful period of reform. under IMF and World Bank supervised structural adjustment programs. This brought down budget deficits and stabilized economies. In return, most of Africa was granted debt relief by its official creditors, both bilateral and multilateral, and aid donors, starting with during the last decade or so. This wiped out most of the official debt. At the same time, China's growth led a commodities boom that stimulated rapid resources-based GDP growth in Africa, where improved economic management, a growing youthful population, and an emerging middle class seemed to offer an attractive new market for investment. And African governments essentially became the new target for a new kind of investor. Funnily enough, the financial crisis of 2008, 2009 in the developed world seemed to reinforce the good impression for a new wave of investors seeking an alternative to developed markets in Europe, America, and Japan. The results were high GDP growth and large foreign direct investment, mainly in extractive industries. You'll see in this slide that this illustrates some of the largest influxes of FDI, foreign direct investment. In 2014, we've got the top there, we've got Egypt, we've got Nigeria, we've got Mozambique, we've got the Republic of Congo, that's Congo-Brazzaville, not DRC Kinshasa, and South Africa. Now, the thing to note about all of these are a snapshot of the countries that received the largest FDI during the period. The thing to note is that in all of those countries, the FDI was largely driven by natural resources project investment, so oil and gas, minerals, mining, and the like. Now, with almost no external debt, and with the World Bank and the IMF encouraging Africa now to manage its own affairs, remember that aid was gradually diminishing and FDI and other sources of finance were increasing in importance. There were few words of caution as this wave of optimism spread across Africa. Now, as we've discovered, not everything was as good as it looked. Firstly, the fiscal position, which we believe that that Africa had got its current account deficits, its budget deficits under control. However, in 2009, in response to the great economic crisis in the developed world, this posed a threat to Africa in the sense that demand was falling for its commodity exports. Now, the man I've got there on the picture is Donald Kaberuka, who was the president of the African Development Bank at the time. In fact, a very distinguished president of the African Development Bank from 2005 to 2015. He was one of the people instrumental in raising the profile of Africa as an investment destination, and indeed in the architect of many reforms. Himself, he had been formerly the finance minister of Rwanda, where he oversaw the reconstruction of the economy after the Civil War. Donald Kaberuka took a very strong view in 2009 that the way to avoid Africa being dragged into recession along with its overseas trading partners was to essentially fiscal expansion. What does this? This means government increasing spending and going back into deficit. This was discussed globally. The World Bank and the IMF agreed that a short-term stimulus was justifiable. Now, the difficulty was that it wasn't just short-term. When the crisis eased, demand began to return, African governments continued to run large deficits. They were increasing, and also to take on quite large levels of debt, both local debt and foreign debt. This became increasingly possible because of the attractiveness to new investors that I've referred to earlier. The debt was to be spent largely on improved infrastructure, which Africa badly needs. Now, at the same time, Donald Kaberuka and other advocates for reform in Africa were arguing that not only had the fiscal position improved, but improvements in policy implementation were happening as well. This meant better public administration, better local tax collection so that as not to be reliant on foreign aid, and job creation and improvements in education, health, and other social services. But were these actually happening? It turned out that they weren't. Secondly, the promised emerging African middle class, which underpinned a lot of the investors' rationale for increasing their activities in Africa, was probably overstated. There was a time when the African Development Bank I think in 2010 produced a report saying that there were something like 100 million middle-class Africans. Now, the difficulty with that is, what do you mean by middle class? How do we define this? Standard Bank of South Africa estimated in 2014 that there were 7.6 million people in Africa with average earnings between $23 and $115 a day. There are at the same time, the OECD, McKinsey's, the management consultants have all produced varying definitions of what middle class means, and indeed of their own view of what the actual position is. The other point about this, of course, is that not only is there not a particularly large African middle class, but also inequality has remained at a very high level. This is largely because the growth, the GDP growth that we've seen in this new century has largely gone into natural resources and come from investment in natural resources industries. This doesn't provide much in the way of jobs for the mass of the public. There is not very much skills and technology transfer. Most of the investment comes from multinational companies. And these are enclave industries which largely bypass the local economy. So in other words, it doesn't help the poor who live in the bush or in the slums. According to the latest World Bank estimates, the share of Africans who are poor fell from 56% in 1990 to 43% in 2012. However, because the population has been growing, the actual number of poor people has risen. Finally, there were some other problems which were masked by the Africa Rising theme. In particular, I think the security situation in some areas has deteriorated, largely due to the rise of militant Islam, which we've had a painful reminder of that in Côte d'Ivoire just the weekend, and it's also plagued the Sahelian region. The same tendency has spread from Somalia across the Horn of Africa, and homegrown militant Islam is now very much a problem in Kenya, which is a key economy for that region. And I think the other factor which has deteriorated is the condition of South Africa's economy. South Africa is the most advanced, the only really industrialized economy in sub-Saharan Africa, and whilst it was for a long time the engine of growth in the Southern African region, its performance has been gradually deteriorating to the point now where South Africa growth is effectively zero, because a lot of its exports come from mining, where demand has dropped, and also because confidence in the government of President Zuma is so low that the international credit rating agencies are on the point of downgrading South Africa's credit rating status from investment grade to what is known as junk bond status. I will go on to refer to that in more detail in a moment. However, despite these underlying problems, as long as GDP growth remained strong, no one seemed to mind. Indeed, there was a new market in African Eurobonds and foreign commercial debt instruments. These are things which were unknown outside South Africa in the region until about 2007. Essentially, this is a new means for governments to raise capital, and the market took off, particularly after 2009 and 2010, where quantitative easing, that terrible phrase with which I'm sure you're familiar, was a response in Europe and the United States. This reduced to the financial crisis. This effectively reduced returns on fixed income in developed world bonds to almost zero. So investors were looking for a higher return in new frontier markets, and Africa seemed to be the place. 2007, Ghana, having just had its foreign debt wiped out by official debt relief, to which I referred earlier, entered the Eurobond market with its initial issue of, I think, $1 billion. Now, there are several difficulties with Eurobonds for developing countries. The first is that it's not program related. The money goes straight into the treasury in one big chunk. So $1 billion comes to the finance ministry. There is absolutely no control from the investors, or even very little knowledge from the investors about what they are going to do with that money. They can spend it on infrastructure, or they can spend it on social services, or they can just spend it on helping to win popularity before an election, which I think is what happened in Ghana. We'll go back to that in a moment. But the trick with foreign debt, of course, is that it has to be used to generate income for the government, which will enable that government to service the loan. That means pay the interest and repay the loan after 5, 10 years, whatever the term of the bond is. So if they're going to take $1 billion in debt, they have to invest it in roads, bridges, power stations, and so on, which will increase GDP, which will feed into taxation, which will therefore fill up the treasury with the money they need to service the bond. If they don't spend it on productive investment, they are heading into a debt trap. This has happened to many countries in the developed world as well as in the developing world, but it's happening in Africa now. There is Carlos Lopez, who is the head of the United Nations Economic Commission for Africa, an expert on these subjects, estimates that the bonds that were issued at its peak in the market, 2013, 2014, when currencies were relatively strong, those Eurobonds are going to cost the countries that issued them something in the region of $10 billion in losses as a result of their local currency depreciation. Now, the problem with foreign debt bonds is simple. If your local currency depreciates and the government earns its revenue in local currency, but its debt obligation is in dollars, then they have a considerably higher sum to repay in local currency terms. So, for example, say Ghana borrows $1 billion when the CD is at 100 to the dollar. By the time it's got to repay its loan, and the CD is, say, 200 to the dollar, it's really going to have to pay back $2 billion. Now, at the same time, if the interest rates are somewhere like 7–8% per annum over 10 years, I'm not very good at calculating compound interest, but I would guess that $1 billion will have been repaid, another billion will have been paid in interest. So effectively, $1 billion of capital will cost $3 billion to the borrower. Now, if you're going to justify that kind of cost, you'd better invest it wisely. So it's a dangerous policy in times of macroeconomic instability. And it's also dangerous if for a country that doesn't have a civil service that can ensure that the money is invested correctly. There are two things that can go wrong. One is political risk. You've got ultimately who makes the decisions in the finance ministry? Politicians do. So they may have initially intended to invest in socially productive projects, but conditions change, political decisions are taken, and the result is a white elephant project which yields nothing. This can happen, and it has happened. The second problem simply is that you may not have a civil service which has carried out sufficiently thorough feasibility studies, done its economic analysis, and got its sums right so that they know what will produce the best return on investment. And I'm afraid there is a lack of capacity in some of the new borrowing countries, and that is to some extent a legacy of structural adjustment whereby the civil service was cut deeply and capacity was eroded. So that is the Eurobond danger. Now, I think Eurobond issuance went from almost nothing in 2007 to a peak of 14 billion in 2014. Countries as even Ethiopia issued a Eurobond, and these are the investors are global financial institutions. They're banks and fund management houses who may even be looking after yours and my pension, the likes of Fidelity or AXA. And these are people who are simply looking for a return on investment. They're interested in yield. They may know very little about the economy of the country in which they're investing, but they're guided by the credit ratings produced by the likes of Moody's, S&P, Fitch, who rate those countries' bonds and economies on the basis purely of their ability to repay. So these are not people who take a very deep or profound view of an economy. They're interested in what is my return and will I get my money back. The rest is up to the borrower to take care of. Now, when China's economy started to slow down sharply, we have all felt the effect, but nobody more than Africa, which had seen a huge boom in demand for its commodity exports and was now seeing a rapid slowdown. The result has been catastrophic in terms of, it's probably time for a new slide, isn't it? Yes, those were some of the, I'll come back to that slide in a minute. Yeah, end of the super cycle. We've got a chart there showing some of the stats, GDP, and the slowdown beginning in 2015. Now, we've got, so the slowdown, I think, took a lot of people by surprise. I think there were a lot of governments in Africa which thought that oil was going to remain at $100 a barrel forever, and that the good times were here to stay. And I think the optimism was encouraged to some extent by the financial community, perhaps misleadingly. We did have, in the meantime, as I've said, debt, both local and international, was creeping up from, I think, 34% of GDP, which is still a relatively manageable level, 5 years ago, to about 44% of GDP as it stands now. The real story behind Africa's growth was that somehow Africa was going to follow the path of Asia. There were big trends that were changing. You had a young working age population, and that this growth was going to be converted into productivity. Well, alas, that doesn't happen overnight, and it hasn't really started happening at all yet. This will take time. My own view is that the place to start is agriculture rather than with industry, and there are signs of improvement there. However, the shock in the financial position has taken a lot of governments by surprise, and I think that the African Development Bank's predictions and their position at the time now has to be radically revised. One thing that they were certainly correct about is that the point holding back Africa's development is the lack of infrastructure. Del Kaberuka himself estimated that there's a deficit of in what Africa needs to build new infrastructure, equating to roughly $50 billion a year. So if Africa needs $100 billion, which more or less is the agreed figure among economists and experts a year for, to build new or maintain existing infrastructure, that means power stations, roads, all the things that a modern economy needs. Roughly 50 billion can be found from local taxation, from aid assistance, from foreign direct investment, but there is a shortfall of $50 billion. What can be done to find that? Well, the African Development Bank has been working hard on this. It has an initiative called Africa 2050, which is essentially designed to try and take the risk out of infrastructure project investment for the private sector in Africa. So they will, for example, produce the feasibility studies. They will negotiate with governments to improve the terms for investors in order to stimulate. There is a wall of capital, we know, in financial markets looking for good projects, but they're nervous about entering infrastructure in developing Africa. And the ADB does have a role in encouraging this. But for the time being, the squeeze is on in government spending. So governments don't have the resources they had 2 or 3 years ago to invest in infrastructure. So those projects are going to suffer. And we're seeing, to some extent, the return of the old days. The IMF is calling. Ghana, Mozambique, and pretty soon Zambia will all have IMF programs to rescue their finances from the threat of default. We're also seeing a situation, let me just see if I can get a more relevant slide. Investors losing confidence. Well, let me just talk about that for a minute. It's not just with resources companies, it's fairly simple. If you've got a copper mine the price below falls, the price of copper falls to a level where the copper mine is no longer profitable, the mining company will close down the mine for a while and wait for the price to go up. Or if they had plans to drill for oil offshore Gabon or offshore Nigeria, for example, but the oil price has slipped to $30 a barrel, the likes of Shell and Total will say, well, we'll just wait until the price improves. But when you've got non-resources investment on the ground, and we're talking now, for example, about banks, food companies, and they start to revise their figures, that's quite serious. Now, I'm sure you know, or everybody knows about Nestle, by some measures the world's largest food and drinks company, announced last year that it was cutting 15% of its workforce based in Africa. Because it said it had made over-optimistic forecasts about the rise of Africa's middle class, that there was going to be greater demand for Nestle's food and drinks in sub-Saharan Africa than before. And the chief executive for Nestle's Equatorial Africa region, in an interview with the Financial Times, blamed a weak and slow-growing middle class for the cuts. I'm going to quote him. He said, "We thought this would be the next Asia, but we have realized the middle class here in the region is extremely small and it is not really growing." He also highlighted the impact on costs of poor transport and local corruption. Essentially, the company's figures fell short of target, and they don't see it improving, so they've cut staff. And they did refer with incredulity to some of the earlier reports, particularly a 2010 survey by the African Development Bank that estimated that Kenya had 17 million people in its middle class. That's out of a population of 44 million people. In fact, a Standard Bank survey last year estimated actually there were only 800,000 middle-class households in the nation. The same time, we've got Old Mutual, one of the world's largest insurance companies, which is essentially a South African based company, but has moved its stock exchange listing to London, and owns one of South Africa's big four banks, Nedbank. It's now restructuring, and it's planning to sell off its stake in Nedbank, a profitable bank, but one whose shares have fallen 21% over the last year. When you also add in the fact that the rand, the South African currency, fell by roughly 30% last year, the loss of earnings, the fall in the share price, and the fall in the value of its earnings in dollar terms must have influenced Old Mutual's decision. You then have you then have the recent announcement by Barclays Bank. Now, Barclays is one of the oldest banks in Africa. It's one of the oldest banks in Britain as well, but it's been there for over 100 years. And they have a new chief executive. There is a restructuring going on there, and they have recently announced that they intend to sell most of their stake in Barclays Africa, which is headquartered in Johannesburg. It came about as a result of their acquisition, Barclays' acquisition of Absa Bank, another of the big four South African banks, and it has interests in places like Botswana, Zambia, Kenya, and Nigeria. So they will be reducing their 65% stake to roughly 20% in Barclays Africa. That's if they can find a buyer. The stake is worth roughly $8 billion. I'm not sure who's going to buy it. Maybe one of the French banks will, I don't know. But I think clearly, the sharp fall in local currencies has hit the profitability in dollar terms of their banks in the region. But also, I think it reflects a medium to long-term view of the prospects of Africa and a revision of those prospects. Mind you, there is also it also tells you something about Barclays Bank itself. It's one of the weaker capitalized big European banks. They're under pressure from the Bank of England to improve their capital adequacy ratio, which is a slightly technical matter, but it seems that they need to make provision for the entire investment holding they have in Barclays Africa, even though they only own 65% of it. And this will, by selling down to 20%, this will remove that obligation from the capital adequacy point of view. It's also we've also seen the fallout of some of the more ill-judged Eurobond deals, particularly in Mozambique. There's a company called Ematum, E-M-A-T-U-M, a strange company by almost any standards. It was launched by the government of Mozambique to build a tuna fishing fleet to be financed by a sovereign dollar bond. Now, I don't know there's anywhere else in the world where a government has gone to the international bond market in order to build up a tuna fishing fleet, but they issued a $700 million Eurobond, and the $700 million did not go on buying any tuna fishing vessels. It actually went into security arrangements, equipment, or let's call it bluntly, toys for the boys under the former president, Arno Guebuza. The money was wasted. For a small and fragile economy like Mozambique, it was a loss that it can ill afford, and it has nearly bankrupted that poor nation. And the IMF is now visiting Mozambique to try and sort out the mess. So these are the kinds of fallouts that we're getting from the harsh and quite rapid change in economic conditions in Africa. I'm now going to talk, well, short-term prospects. Let's face it, it's still not bad. When you look at forecasts for growth in Africa relative to other regions in the world, well, that's a level of growth that I think the government in France would be very happy with. But at the same time, don't forget that Africa needs to grow fast to catch up, and you've got to also discount the fact that you've got population growth of roughly 3% anyway. So Africa has to pedal harder, faster to keep up or to get ahead. Now, I talked a little bit about South Africa. It's coming to a critical point, and it is important. It's by official estimates, it's no longer the biggest economy in Africa. It's the second biggest. Nigeria surpassed it when GDP calculations were rebased. But there is a very competent finance minister called Pravin Gordhan. He's talking to the credit rating agencies and the investors in order to try and rescue the position. But a downgrade of its credit rating would be a disaster for such a developed economy. Just going through, I'm going to quickly talk about Nigeria. Buhari's second chance. President Buhari, elected last year, was president way back in the early 1980s when he was a military ruler. He's serious. He wants to cut corruption. He wants to restore security in some of the worst areas affected by terrorism, and diversify the economy. And he's got a lot of work to do, but there he is. That's a picture of him on the right. And the man with the black hat is the man he replaced, President Goodluck Jonathan, who failed on almost all of those counts. Very much an oil-dependent economy. So budgets are tight. Kenya, the hub for the East African region, doing quite well, doesn't rely on natural resources exports, but has quite severe challenges due to high levels of debt. Well, I think I've made that point about the being far from recovery. And finally, this is just a slide I've thrown in out of interest, just to show how much potential there still is for foreign investors. The insurance market, you can see that there's almost, apart from South Africa, insurance companies are hardly present at all on the continent. I think I've run out of time, so I'll stop now.
Thank you very much. So I'd like to express my thanks to Paul for that very interesting presentation, which made some of the more complex economics of debt accessible to all of us here in the lecture room. So now we have time for questions. We've about 15 minutes for questions. There is a microphone which will circulate as required. So I'd just like to say, is there anybody who'd like to ask any questions? Man back there.
I have a quick question. As investment trends might change over time, how equipped do you think African nations are, if you could speak overall and maybe give some specific examples, are equipped to handle inflation risks?
Inflation?
Yes. How
right.
well do you think the African nations are overall, or if we give some specific case studies to handle inflation if the investment trend might change in the future?
Just so I can understand, your question is about inflation rather than investment? Controlling inflation?
Yes. Yes, right. And the effect on investors.
Oh, effect on investors.
And
well,
how equipped are the governments to handle the risk?
Well, I think inflation tends to be in the high single digits across Africa generally. When it hits double digits, it is a threat to investment, particularly when I think the real threat to investment is currency depreciation. So a foreign investor will invest will take hard currency, invest in local currency, then repatriate the dividends. And if the local currency has depreciated, then in hard currency terms, it's not as good a dividend, to put it very simply. So I think the real fear for most investors, foreign investors at the moment, is currency depreciation. Obviously, inflation doesn't help as well. How well are they equipped to deal with it? Well, I think they are well equipped to deal with it, because I think that's one of the advantages of the structural reforms brought about that I described earlier. They do know how to deal with it, but it means pain. It means cutting budget spending. You can't print more banknotes like you did in Zimbabwe. That just makes things worse. So it means cuts, and it can be painful. Some of the inflation is imported. If the local currency depreciates and it's importing a lot, then the cost of those imported goods goes up, and that feeds into the general price index. So I hope that answers your question.
Okay, we have another question down here. We'll pass the microphone.
Thank you. I have 2 questions. First, you say agriculture must be put first, must come first. We have been hearing this for many, many times. It is good. I would like to know whether it is possible to have a modern agriculture without producing steel. Do you know any country in the world who has produced modern agriculture without producing steel? And first, second question, what about Democratic Republic of Congo and the Inga Dam? What is the link with the debt crisis? Because it is said that this dam, if it is built, will cost a lot of money, and which is what is the link with the debt burden? if I may say. Thank you.
So, I'll take the first question first. The short answer is I don't know of any such example. Agriculture without producing
That's very
steel.
good. So let us stop saying this every time. UK started everything from steel. Any country starts from steel. China was the first steel producing country before being anything else. So we must produce steel in Africa. Without steel, you cannot build infrastructure. You say we need infrastructure. This cannot be done without steel. So we know that we have to stop sending all ions and coal like South Africa or Mozambique and those countries abroad and build steel in order to build infrastructure. I'm coming from Strasbourg. I can come here with train and everything is there. So let us talk about what is strategic, and it is steel. Without steel, we cannot build any modern country.
Good point.
No agriculture.
Good point. Shall I just go on to your second question?
Thank you.
And perhaps you'd like to make a general speech about steel, because you're clearly got good views on it. But let me just go back to Inga Dam. And I'm not sure that the debt crisis has any effect on the prospects of that. This is the Inga Dam 3, which potentially this is enhancing this is a hydroelectric power plant which will be much bigger than anything that's ever been built in Africa before, and using the enormous power of the Congo River could produce electricity to export all over Africa. Essentially, if they built the kind of plant that they say they could, and there are a lot of foreign companies interested, this could generate this could wipe out Africa's power deficit. I think there are other reasons why it hasn't been built, and I think it's to do with lack of confidence in the government of the DRC, Congo-Kinshasa. I don't think it's to do with the debt.
Are there any other questions? Nick?
I can hear you.
It's for the recording purposes.
Paul, throughout your talk, you've been referring to the IMF as a reactive force when things go wrong. And my question is, should the IMF take on a more proactive and advisory role in, for example, looking at feasibilities of buying tuna fleets rather than stepping in as first aiders to repair sort of the bad situations?
Well, that's an interesting question. I don't know how the IMF would answer that one. During the time when things were going wrong, what was the IMF doing? Were they asleep? Were they having a rest? Were they saying, "Okay, we've sorted you out. You're on your own now. You say you know what you want to do. Let's prove it"? I don't know. But for a while, the IMF took a back seat. But don't forget, the IMF is there for dealing with systemic failures and crises. It's not supposed to be sitting in front with the driver all the time. Maybe they should have been more vigilant. Maybe they should have been more aggressive. I'm not quite sure. It's a question, for the IMF. One thing I would say, though, is that when the debt relief deal was agreed, the highly indebted poor countries, known as HIPC, there were two conditions, not binding, but made clear. One was that the debt relief that the money saved by debt relief should be invested in ways to alleviate poverty across Africa, to make growth sustainable, not simply volatile. And the second was that debt in future, to avoid having to step in and bail out and argue about debt relief a second time round, debt sustainability was the key. That debt sustainability means borrowing only up to a level at which you can service your loans. And the IMF has every year it produces a debt sustainability analysis for each country in Africa. My own view, and that's fine, But my own view is that African governments should be doing their own debt sustainability analysis as well.
Okay. I could have a question perhaps for you, Paul. When you were talking about the link between debt, Eurobond debt, and investment in infrastructure, I thought briefly of the golden rule of public finance. But interesting question is this thing about exposure to risk linked with the currency in which the debt is denominated, okay? On the one hand, you rightly said there's the Eurobond. The Eurobond situation is basically where the less developed country or emergent economy borrows in dollars or euros or something like that. And that, I've always said, that's a huge risk for any country to take, okay? But then when we were talking about inflation, you spoke about the risk for investors coming from inflation. But the investors have no risk if the debt is denominated, at least there's no currency risk, if the debt is denominated in dollars or euros. Do you have any idea, just offhand, what percentage or what proportion of African sovereign debt is denominated in local currency terms and what proportion in foreign currency terms?
I can't give you a precise figure off the top of my head, but it's the minority, fortunately. And African average debt levels, as I say, has risen to 44% of GDP, which is very respectable in international terms. It's slightly dangerous if it's a country which is unable to raise local tax. I mean, for example, here in Britain and France, we have levels of GDP ratio something like 100% government debt to GDP. How do these governments keep going? Well, because they tax us a lot. But in Africa, governments don't tax heavily. Local debt is the largest component. I would say it's roughly 2/3 local, 1/3 foreign denominated. The problem with local debt, you don't have the currency risk, but the interest rates are much higher.
Of course. Thank you for that. Are there any other questions everybody has? There's a man over there with a question. We have the microphone over there, please.
Good morning, sir, and thank you very much for this presentation. You were referring to the terms of a civil service for Africa. Which kind of organization could take this role for the whole Africa? And how could it be an African initiative instead of an European or American one? Thank you very much.
Well, I think you really have two Pan-African institutions. The African Union and the African Development Bank. I don't think the African Union logically is the place to do it, but it's really not a very effective organization in terms of economic and governance reform. It's largely a club of presidents, a political association. It achieves very little in the terms that you're describing. The African Development Bank is a more realistic institution to achieve that, but I haven't seen them prioritizing this. Personally, I think they should.
Are there any other questions from anybody? No other questions? Okay, well, I think we've in fact gone through our time. So I'd like to take the opportunity to thank Paul for a very interesting presentation that gets to the heart of some of the key challenges, I think, for Africa. I know everything is not finance, but if the finances are not in order, it's difficult to get anything else in order. So I'd like to join me in giving Paul a well-deserved round of applause. Thank you.